All right, let's jump right into this explainer and tackle the absolute million-dollar question surrounding MicroStrategy, or as you probably know it, MSTR. Whether you're refreshing your portfolio every 5 minutes or just catching the weekly headlines, this company has become one of the most fiercely debated stocks on the market. We're going to impartially break down the numbers, the competing narratives, and the very real risks involved. Our ultimate goal today is to answer a surprisingly tricky question that has totally divided Wall Street. Is this current moment a once-in-a-lifetime buying opportunity, or is it a value trap just waiting to pull investors even deeper into the red?
To really grasp where we're at right now, we've got to acknowledge the sheer gravity of the situation. 70%. For years, MicroStrategy was basically Wall Street's ultimate proxy for Bitcoin. People literally joked it was running an infinite money glitch. The playbook was brilliantly simple, really. You buy Bitcoin, watch the stock trade at a massive premium, sell more stock at that premium, and use the cash to buy even more Bitcoin. Rinse and repeat. But then, rather suddenly, the music stopped. Over the past year, the stock took a staggering 70% dive. That premium to its Bitcoin holdings, which was the literal engine of its growth strategy, has completely evaporated.
And just when you'd think investors were desperate for some reassurance, Executive Chairman Michael Saylor comes out and explicitly tells common shareholders to, and I quote, prepare for difficult years. Right? When the architect of a company's entire financial strategy publicly signals that kind of turbulence ahead, it sets the stakes incredibly high for retail investors. It absolutely sets the stage for this intense debate between those who see a historic bargain and those who see a systemic failure. So here is our roadmap for today's explainer. We're going to cover the MicroStrategy crash, the bull case, the bear case, the metrics to watch, and wrap it all up with the final verdict.
Part 1. The MicroStrategy crash.
Moving on to part 2, the bull case.
Okay, so despite the absolute carnage of that 70% drop and the ominous warnings from leadership we just talked about, the broader analyst consensus is actually still a strong buy. With the current price hovering right around $104 a share and the average analyst target sitting way up at $229, the math jumps right out at you. Analysts are projecting a massive potential upside of over 119% from where we are trading today. Even after cutting some of their previous targets, major firms still see a really clear path to extraordinary gains. Now, hope isn't an investment strategy, right? So let's actually walk through the 3 concrete pillars driving this bull case. Number 1, a historically cheap valuation. For the first time in years, the company is trading at a discount to the value of its underlying assets. So you're basically buying Bitcoin on sale and getting a legacy software business thrown in for free. Number 2, they fortified their balance sheet with a $3.75 billion cash reserve. This isn't just a pile of money sitting there to buy more crypto, it's a strategic war chest designed to cover their interest and dividend payments for over 2 years, actively protecting them from ever being forced into a fire sale. And number 3, immense leverage to a Bitcoin recovery. And where does that leverage come from? 840,447. That is the staggering amount of Bitcoin MicroStrategy actually holds. To put that into perspective for a second, every single time the price of a Bitcoin goes up by just $1,000, that translates to roughly $840 million in added value for the company. So if you're banking on a massive crypto comeback, grabbing the stock at these beaten down levels is basically a heavily discounted, highly leveraged bet on that exact recovery scenario.
All right, part 3, the bear case.
But we've got to flip the coin here. If you look under the hood, the bears argue this company is facing massive structural headwinds that go way beyond your day-to-day volatility. To really get this argument, we need to talk about MNV, or multiple to net asset value. This is just a metric that compares the stock's market price to the actual value of its underlying assets. Right now, that multiple is sitting below 1.0. Why does this finance jargon matter to us? Because without that premium, the company's historical growth engine completely stalls out.
Let's compare the old strategy to the new reality. Back in the day, when the MNAV was comfortably above 1.0, the company could just issue new shares at a huge premium to fund more asset purchases. It was accretive. It actively benefited the company. But today, in the new reality where the multiple is below 1.0, that old infinite money glitch is completely broken. Issuing new shares today is actually dilutive, meaning it actively hurts existing shareholders. The mechanics that pumped this stock up to its all-time highs just do not work in current conditions.
And making that broken mechanic even worse are the crushing costs. We're talking $13.5 billion in preferred equity and $8.2 billion in debt, because I guess regular crypto volatility just wasn't enough of a roller coaster ride.
Those preferred shares are definitely not cheap either. They carry dividends as high as 11.5%. To show you how fast that spirals, in just the second quarter of 2026 alone, the preferred stock dividend cost is going to be over $400 million. This massive cash drain is the primary reason management had to hit pause on buying more assets. They literally just need all that cash to service their existing debt.
Which brings us to a really stark observation from short seller James Chanos. He points out an astonishing $80 billion gap between the company's market value and its actual underlying Bitcoin holdings. The core bear argument here is that owning this stock is emphatically not the same as just owning Bitcoin. When you buy MSTR, you are inherently taking on immense management risk, debt risk, and financing risk, all for the privilege of a premium that, as we just saw, doesn't even exist anymore.
Part 4. Metrics to watch. So whether you're leaning toward the bullish upside or you're spooked by the bearish structural warnings, you need objective data points. Here is your clear, 4-step checklist of vital metrics to track. Number 1, obviously, the Bitcoin price. It's still the primary driver. Number 2, that MNAV premium. If it stays below 1.0, the stock is fundamentally going to struggle to find momentum. Number 3, refinancing or buybacks. If the company can buy back its preferred stock at a discount, that is a massive green flag that the balance sheet is recovering. And finally, number 4, watch those dividend payments closely. If they ever show signs of struggling to cover those preferred dividends, the situation could deteriorate incredibly fast.
And lastly, part 5, the final verdict. All right, it's time to bring it all together. The most impartial summary of all this data is simply this. MicroStrategy has to be treated as a highly speculative, high-risk, high-upside play. It is absolutely not a safe haven, and despite trading below its net asset value, it behaves nothing like a traditional value stock. If you're entering this trade, you've got to treat it almost exactly like a venture capital bet. You need a 3 to 5 year time horizon, and honestly, you must have the stomach to endure potentially another 30 to 40% drop before seeing any kind of meaningful recovery.
The bull case for a generational entry point is very real, guys. But the bear case about structural debt and a broken financing model, that is just as valid. Your job as an investor isn't just to follow the hype, but to decide which of these mathematically backed narratives you believe will win out over the next decade. So having seen the actual data and the structural reality behind all those flashy headlines, I'm going to leave you with this. Are you buying the dip on MSTR, or are you staying far, far away?